coming up on Retiring Well with Michael Reese.
Over $100,000 lost to the IRS. Money that's paid out because not paying attention to the impact of taxes. What a tax planner does is every single year, they're sitting down, looking at your return and identifying, should you be doing some Roth conversions? I'll give you a good example of this.
Quite honestly, should have been doing quite the opposite. Utilizing that low bracket while they're trying to take money out of their IRAs.
Retiring Well with Michael Reese, helping you make smart decisions with your money so you can live a better life. Today is the day you can take back control of your money. Retiring Well with Michael Reese, where we believe your best is yet to come.
Welcome to Retiring Well. I'm your host, Michael Reese, and we've got a great show this week because we're talking about taxes, tax planning, and tax preparers. And I know, taxes, you're thinking, oh, shoot me in the head. Who wants to talk about taxes? I mean, if you're a CPA, I know this is very exciting to you, but the average person, you think about taxes, hey, you're probably like me, you're thinking, gosh, thank God for TurboTax, right? If it weren't for that, I remember the days during tax season when I was a kid. I remember my dad on the kitchen table, papers everywhere, filling out these tax returns by pencil because you had to erase all the time in those days. What a pain. My dad was never in a good mood on those days, right? Anyway, we're going to have a great show this week because I think you're going to enjoy how we look at taxes in this week's show. All right. This first segment here, what I really want to spend some time on is to help you understand the difference between what you would call a tax preparer and a tax planner. There is a huge difference, and you need to know because odds are good that you've never talked to a tax planner. You've talked to a tax preparer. Odds are good. So let's go ahead and let's identify what's going on here. So here it is. Let's imagine it's tax season. And tax season means that it's, March, April, and you've got to get your taxes filed. Now, one of two things are happening in today's world, right? Number one, you're rushing over to Best Buy or somewhere so you can buy the latest version of TurboTax or some equivalent program. You're going to do it yourself. So you go buy that program, you put it in your computer, you start answering questions. And what's the purpose of the program? The purpose is to help you prepare your return. In other words, it wants to help you make sure you're getting the right numbers, right? The right numbers in the right boxes. Well, that's one thing you could do. What's the other thing you could do? Well, you could go find yourself a CPA, an EA, which stands for Enrolled Agent, somebody that does tax returns. Maybe you go to the H&R Block office, whatever. Maybe you got some fancy CPA firm. And you go there and you say, all right, tax time. And again, they're taking your information, and what are they doing? They're putting the right numbers in the right boxes. Now, how much tax planning is happening with your CPA during tax season? Well, you might think you've got some tax planning going on because they say to you, hey, do you want to put some money in an IRA, a tax-deductible IRA for the year? Have you done that? Let's get that done. You might think they're doing tax planning when they say things like that, but the reality is they're doing no tax planning right there. Think about it. Have you ever sat in a CPA's office during tax season? These guys, I don't know why anybody would do that job. These guys are nuts. They get there at like 6 in the morning. They're there till midnight, all day long, crushing returns. It's all they do. They don't have time. They don't have time to do tax planning. All they have time for is let's get the right numbers in the right boxes. That's it. Now, what does a tax planner do? Here's how you know if you have a tax planner. What a tax planner does is they call you after tax season. Maybe it's May or June. You got to give them a little bit of time because by April 15, you know what happens on April 16? All these CPAs are gone on vacation, and boy, oh boy, do they deserve it, right? So here we are. It's May, it's June, it's tax season's over. What a tax planner is going to do is they're going to call you up on the phone. They're going to say, hey, Bob and Susan, I want you to come on in. Let's review your tax return in detail. Let's identify if there's anything you can do today to reduce your taxes, for the rest of this year. And also, let's take a look at where you're heading going forward. What happens, for example, down the road? You've got these retirement plans. Where are they taking you? Should we be doing some Roth conversions? Should we be doing that a little bit each year? That might be looking at your return and saying, well, gosh, by the way, heads up. Do you know if one of you passes away, the survivor is a single taxpayer? Let's take a look and see what your tax return looks like if that were to happen. And do you like what you see? If you don't, gosh, maybe we can do some planning to help you out there. In other words, a tax planner goes into a deep dive, and they help you evaluate what might or might likely happen in your life and look at the tax consequences to make sure you're on the right track. So do you have a tax preparer, or do you have a tax planner? Because the reality is, you should have both. Now, I don't want you going anywhere, because coming up, we're going to dive into this in some more detail and share with you why this is so important when it comes to your retirement planning.
Are you ready to face today's retirement challenges? Are you prepared for potential market corrections and economic downturns? Are you implementing viable tax strategies to reduce your liability and protect your assets? Are you able to make informed decisions to safeguard your retirement savings and income? Centennial Wealth Advisory presents Mastering Today's Retirement Challenges. We are Northern Michigan's financial advisors, specializing in retirement planning with offices in Traverse City, Petoskey, and Gaylord, and we invite you to an informative presentation with a complimentary gourmet dinner. Learn how to use the new tax reform to your advantage, the best way to generate lifetime income, how to identify and manage financial challenges, how to maintain growth opportunities and reduce risk, and much more. Call 888-608-5825 to register and choose the date and location that works best for you. Tuesday, July 24th at Stafford's Bayview Inn in Petoskey, or Tuesday, July 31st at the Park Place Hotel in Traverse City. Presentations start at 6 p.m. and are free to attend with a complimentary gourmet dinner to follow, but seating is limited and fills quickly. Call 888-608-5825 to reserve your seats today. There is no cost and no obligation. Don't miss this important presentation, Mastering Today's Retirement Challenges. Call 888-608-5825 today.
Hi, I'm sitting here with Larry Flynn. Thanks for being here, Larry.
Thank you, Mike.
He's one of the advisors at Centennial Wealth Advisory. And folks, as you may know by now, we certainly invite you to come visit with us. It's absolutely free to get a second opinion on your retirement planning. And I think it's important to get a second opinion from someone who's a specialist when it comes to retirement planning. And Larry, I'm sure they're wondering, if they pick up the phone and they call and come visit with you, what can they expect? What's that experience like?
Well, Mike, they can expect not to get hard sold, okay? We're going to greet them warmly. We're going to sit down and talk to them a little bit about maybe their story, where they're from, where they grew up, how they met their spouse, what they're dreaming of doing once they get soon to be retired or retired.
Kind of what are their goals, right?
Yeah, what are your goals? We're going to talk to them a little bit about who we are, what we do, show them how we do things, especially dealing in the market realities we find ourselves in today.
Got it. So essentially, they're coming in, you're learning a little bit about what's important to them, what their goals are, what they're trying to accomplish. I'm sure you're taking a look at what they're doing so far. You maybe share a little bit about you, and it's just in a very relaxed atmosphere.
That's right.
And there's no cost to do this. Is that correct?
No cost. No cost.
All right. So, folks, there you go. I mean, it sounds very simple, very easy, very laid back. There's no reason for you not to just pick up the phone, call the number on the screen, come visit us, get that second opinion. You'd be glad that you did. Hi, this week in Chalk Talk, we're going to talk about the difference between tax-efficient investing and tax-inefficient investing. And as you can see here, I've got a little chart up here, or an illustration might be a better way to say it. Let's imagine that you have an investment that's very tax efficient. And by the way, big difference between financial advisors here, because a lot of financial advisors, I shouldn't say a lot, some pay attention to that. But not many do. Very few advisors actually pay attention to taxes and how it impacts the results of your investment outcomes. So here we go. Let's say you've got $100,000 and you earn 7% over a 20-year period, right? So 7% over 20 years. And you are investing that money in such a way that it is tax efficient. So it's very clean when it comes to, from a tax perspective. You could see $100,000 done properly easily grow to $386. In other words, almost 4 times. Well, that makes sense because the rule of 72 says you take your investment return, 7%, you divide it into 72, and that tells you how long it takes your money to double. So 7 into 72 says, well, your money doubles every 10.2 years, or something like that. And you say, okay, well, 10 years, 100 grows to 200, and then 200 grows to 400. That makes sense. It's pretty close, right? So 100 to 386, that's cool. We love that. That's beautiful. Now, here's the question. How do taxes affect these outcomes? I mean, if you think about it, very few advisors pay attention to this. They just kind of invest the money and hope for the best. Well, let's assume, for the sake of discussion, that here we have investment manager B, who's not so tax efficient. And they earn the same 7%. They invest for the same 20 years, but they're just not quite as good with the tax side. In other words, they got to pay some taxes as they go. They're just not paying attention to stuff. It is very typical that during that exact same time period, and the question is, okay, how much of an impact might that have? I mean, here we're at 386 by the person that's very tax efficient. How much of an impact could it really have? Well, it's not uncommon. When we did the math recently, we said, you know what? This guy who's not really paying attention to taxes invests like a normal investment firm does, they end up with 278. In other words, that's about $100,000 less. In fact, more than that. Over $100,000 lost to the IRS. Money that's paid out because not paying attention to the impact of taxes. So, yeah, I know this seems like, and here's the problem. This is really important because here you are at home. You're trying to figure out, okay, well, what's the big difference? You're just, when you look at 2 accounts, like account number 1 and account number 2, and you look at history, how they done, and they both have 20-year histories, and they both say, look, we've earned, account number 1 earned 7% a year over the last 20 years. Account number 2 earned 7% the last 20 years. They earn the same thing. How are you supposed to pick which one to put your money into? If it's IRA money, it doesn't matter because taxes don't matter. But if it's after-tax money, maybe this was an inheritance, or you sold a piece of property, or maybe you just saved up some money in your savings account, you got $100,000 to invest. If this is after-tax money, it matters. 7% is not equal to 7% in an after-tax environment. You have to take a look at the tax consequences of what's going on there. And here's the problem from your side of the table. It's really hard. It's really hard to figure out which manager is investing tax efficiently and which manager is not. Quite frankly, a great question to ask a financial advisor that you're talking to might be, how do you determine, what process do you use to determine which manager is investing more efficiently than the other? The answer to that question could really make your decision for you as to which advisor you might want to go with.
ready to face today's retirement challenges? Are you prepared for potential market corrections and economic downturns? Are you implementing viable tax strategies to reduce your liability and protect your assets? Are you able to make informed decisions to safeguard your retirement savings and income? Centennial Wealth Advisory presents Mastering Today's Retirement Challenges. We are Northern Michigan's financial advisors, specializing in retirement planning with offices in Traverse City, Petoskey, and Gaylord, and we invite you to an informative presentation with a complimentary gourmet dinner. Learn how to use the new tax reform to your advantage, the best way to generate lifetime income, how to identify and manage financial challenges, how to maintain growth opportunities and reduce risk, and much more. Call 888-608-5825 to register and choose the date and location that works best for you. Tuesday, July 24th at Stafford's Bayview Inn in Petoskey, or Tuesday, July 31st at the Park Place Hotel in Traverse City. Presentations start at 6 p.m. and are free to attend with a complimentary gourmet dinner to follow. But seating is limited and fills quickly. Call 888-608-5825 to reserve your seats today. There is no cost and no obligation. Don't miss this important presentation, Mastering Today's Retirement Challenges. Call 888-608-5825 today.
Welcome back. So this week we're talking about tax planning, and what I want to talk about right now is Roth conversions and, quite frankly, the annual need to be looking at transitioning out of highly taxed assets like IRAs, 401ks into tax-free assets like Roth IRAs or maybe even life insurance of some type. Now, I want you to think about what happened. Let's go back 20 years ago. Right? It was, I think, 1998 when Roth IRAs first came out. I remember when they first came out, what happened? Everybody rushed to their tax advisor, right, to their accountant. Hey, should I do this? Should I do this? And the accountant shared, his or her opinion at the time. And that was the last conversation that people typically had. Well, not really the last, because over that 20-year span, probably what happened is somewhere along the way, once or twice, you might have gone back and said, hey, should I be doing some Roth conversions? I hear about Roth conversions. Does it make sense? And again, typically the answer is, probably not, or maybe a little bit. But usually it's probably not, because you're too high of a tax bracket, or this reason or that reason or what have you. Right? But here's the deal. The deal is that you have these discussions that the accountant didn't bring to your attention, you brought to their attention. You asked them a question, they answered, and you're done thinking about it. Well, that tells you, again, you have a tax preparer, right? Because we've been talking about what's the difference. But what does a tax planner do differently? Well, here's what you should be doing. What a tax planner does is every single year, they're sitting down, looking at your return and identifying, should you be doing some Roth conversions? I'll give you a good example of this, right? One of our clients has $800,000 in an IRA. Again, pretty big number. You might have more, you might have less, doesn't really matter. What matters here is that when every year we would sit down and look at their tax return, you know what we learned? We learned that they had room, they could convert, in their case, $20,000 a year and stay in the 15% tax bracket. So we've been doing that now for about 7-8 years. It doesn't sound like anything. They got 800 grand. What's the value of $20,000 of a conversion? I mean, whoopee. However, we've been doing that, 7 years, 8 years, 20,000 a year, 7-8 years. That's $140,000, $160,000 that's now in Roth IRA. They only had to pay a 15% tax to do it. How cool is that? Right? That's what happens when you pay attention. Little things add up to big things. Tax planners help you identify those little things that add up to big things. That's $140,000, $160,000 that they're never going to pay tax on again. It's tax-free for this point forward. I mean, that's kind of a big thing over time. What else is going on? Well, 2018 has brought us a brand new tax code, right? So a whole new tax bill, whole new tax everything. Did you know that this new tax code is allowing a lot of people to convert from IRA to Roth IRA and do so at maybe a 20-25% discount from what they would normally pay? Why is your tax planner not talking to you about that every year? It's because you don't have one, right? You probably don't have one. You probably have a tax preparer. Every single year. Taxes are not something that you look at once and you forget about. It's an every year thing. Every year. You know, what happens? I had another client. You know what happened? They got an inheritance. They got an inheritance from their when, you know, the mom passed away, they received an inheritance, about $300,000-$400,000. And you know what? Everybody they talked to was really excited about, here's how you invest that new money. You know why this person ended up working with us? Because we said, hey, we could talk about investing that money, but at the same time, let's take a look at the tax consequences of how that money's invested. How is that going to impact your current tax situation? Could you use some of this money to pay for Roth conversions instead? Right? You're talking about investing. Maybe it'd be better invested by using it for Roth conversions. In other words, you want to make sure that your investment planner and your tax planner, you want to make sure they're integrated, that the right hand and the left hand know what each other's doing. That's the value of working with the right firm.
Are you ready to face today's retirement challenges? Are you prepared for potential market corrections and economic downturns? Are you implementing viable tax strategies to reduce your liability and protect your assets? Are you able to make informed decisions to safeguard your retirement savings and income? Centennial Wealth Advisory presents Mastering Today's Retirement Challenges. We are Northern Michigan's financial advisors, specializing in retirement planning with offices in Traverse City, Petoskey, and Gaylord, and we invite you to an informative presentation with a complimentary gourmet dinner. Learn how to use the new tax reform to your advantage, the best way to generate lifetime income, how to identify and manage financial challenges, how to maintain growth opportunities and reduce risk, and much more. Call 888-608-5825 to register and choose the date and location that works best for you. Tuesday, July 24th at Stafford's Bayview Inn in Petoskey, or Tuesday, July 31st at the Park Place Hotel in Traverse City. Presentations start at 6 p.m. and are free to attend with a complimentary gourmet dinner to follow. But seating is limited and fills quickly. Call 888-608-5825 to reserve your seats today. There is no cost and no obligation. Don't miss this important presentation, Mastering Today's Retirement Challenges. Call 888-608-5825 today.
Thanks for joining us today. My name is Art Canfield and this is Larry Flynn, and we're here today to continue the conversation you've been watching today about taxes, tax planning, how that can affect you in your retirement. You know, Larry, there's so many different ways and things that people need to look at. I mean, we could talk for hours and hours about this, but you know, why don't you touch on some of the kind of the hot things that you see on a day-to-day basis that can help retirees?
Right. Well, first of all, tax planning is so vital, right? We've talked about this in other shows where when we're doing income planning, one of the biggest considerations is how's that income going to get taxed, right? I think of that story of somebody we met with probably about 2-3 months ago, right? They talked to their advisor maybe 10-15 years ago, and they said, okay, here's what I have, where should I take income from? And they had IRAs, they had Roth IRAs. And the advisor said, well, pull it out of the Roth IRA because then you don't have to pay any tax on it, right? So for 10-15 years, they're dwindling down their Roth IRA account, and their IRA account was growing. And they were in the low tax bracket. Can you imagine that?
Yeah, sounded good at the time, right?
Well, right.
Yeah.
They quite honestly should have been doing quite the opposite, utilizing that low bracket while they're trying to take money out of their IRAs. When they found out that they had wasted 10-15 years and that's what they had done, they were not very happy. They could have used some advice. I think the other mistake people make is they think their tax preparer is a tax planner. You know, they think this is a person that's going to, run all those mock return scenarios for me to tell me how the best way to take income from this, right?
Yep. Yeah, and the one thing that we hear a lot here is that there's also, they may have a tax preparer and they might have a financial advisor, but there's no tax planner at all, and those two aren't talking, right? That's right. I mean, and that can be a challenge in somebody's retirement there too.
Well, you're aware, I had my own tax and accounting practice for over 25 years. I've told this story to people before. As much as I would love to do a return, sit down and review it with them after, try to offer some recommendations and advice, I'd always give them this perspective. When do most people get most of their tax documents? Think about it.
Right. Yeah. You're talking what? Late February, early March?
Yeah. I mean, a lot of them come end of January. Sure. If they have investment accounts, they're getting them middle of February, right? Whether they open up their mail that says important tax information or not, they've got it by middle of February, right? Well, I can tell you that 80% of the people typically always wanted to get their returns done by April 15th. I don't know what that was about, you know. I think a lot of people would say, well, if I extend it, aren't I most likely going to get audited? All right, I would tell them, no, that's not necessarily the case, but 80% want to get done by April 15th. So if most people are getting their docs by February 15th, and they want it done by April 15th, how much time is that?
Right, not enough, right?
It's 2 months.
Yeah.
It's 2 months. How much tax planning do you think I was really doing in that period of time?
Yeah.
Not a whole lot, right?
Yeah, when you're doing a couple thousand returns or whatever.
Honestly,
maybe.
I'm just trying to get returns out the door, sure. Right? The kind of tax planning, when we're talking about this in the show, is not just sitting there looking at your return and offering some recommendations. It's IRA exit strategies. You know, if you have an IRA, you have a 401k, people don't recognize they got a partner in that account, right? Because what happens when you take money out of your IRA, your 401k, who's there to take a piece of it?
The not so silent partner anymore, right?
Right, Uncle Sam, right? Yeah. And isn't it funny? He wasn't there helping you work for it all those years, but now when you get ready to take it out, he's there to take his share of it, right? So what we want to do in this kind of tax planning is we want to find out a way to get that partner out of our IRA, right? At the cheapest possible way, right? So liken it like if you and I had a piece of real estate together, right? And I knew you were a partner, but you know, I was kind of wanting to enjoy maybe that property on my own, right? I would try to find a way to buy you out, right? But would I want to give you the most for it?
Right.
Not necessarily, right? I'd probably want to find the cheapest way to get you out. So IRA exit strategies and planning is so very, very important. Anyway, just want to thank you for joining us today. If this is a subject that you maybe want to talk to Art or myself on, we'd be glad to meet with you. But again, thank you for joining us.